All right, reading 55, Fundamentals of Credit Analysis. That's a heavy chapter, so we'll just get right into it. Learning outcomes: the candidate should be able to describe credit risk and credit-related risk affecting corporate bonds. Describe default probability and loss severity as components of credit risk. Describe seniority ranking of corporate debt and explain the potential violation of the priority of claim in a bankruptcy proceedings. Distinguish between corporate issuer credit rating and issuer credit rating, and describe the rating agency practice or notching. Explain risk in relying on rating from credit rating agencies. Explain the 4Cs: capital, capacity, collateral, covenant, and charter of traditional credit analysis. Calculate and interpret financial ratios used in credit analysis. Evaluate the credit quality of a corporate bond issuer and on the bond of an issuer given key financial ratios and the industry. Describe factors that influence the level of volatility of yield spreads. Explain social considerations when evaluating the credit of high yield sovereign and non-sovereign government debt issues and issuers and issuees. Excuse me. Okay, sorry. Introduction: with bond outstanding worth many trillions of US dollars, the debt market plays a critical role in the global economy. Companies and governments raise capital in the debt market and fund current operations, buy equipment, build factories, roads, bridges, airports, and hospitals, acquire assets, and so on. By channeling savings into productive instruments, the debt market facilitates economic growth. Credit analysis has a crucial function in debt capital markets. Efficiently allocating capital by properly assessing credit risk, pricing it accordingly, and repricing it as risk changes. And how they decide. How do fixed income investors determine the riskiness of debt, and how do they decide what they need to earn as compensation for that risk? This reading covers the basic principles of credit analysis, which may be broadly defined as the process by which credit risk is evaluated. Readers will be introduced to the definition of credit risk, interpretation of credit ratings, the 4Cs of traditional credit analysis, the key financial measures of ratios used in credit analysis. The reading explains, among other things, how to compare bond issuers' creditworthiness within a given industry, as well as access industries and how credit risk is priced in the bond market. The reading focuses primarily on analysis of corporate debt. However, credit analysis of sovereign and non-sovereign, particular municipal government bonds, will be also addressed. Structured finance, a segment of the debt market that includes securities backed by pools of assets such as residential commercial mortgages or asset-backed securities, as well as other commercial loans, will not be covered right here, right? Because we covered it, 2 chapters ahead. We covered, I believe, in reading 53. I'm drinking honey lemon oolong tea today. The key components of credit risk: default probability and loss severity are introduced in the next section, along with such credit rating risk as spread risks. Okay, credit risks. Excuse me once again. Credit risk. Credit risk is the risk of losing resulting from borrowers failing to make full the timely payments of interest and or principal. Credit risk has 2 components. The first is known as default risk or default probability, which is the probability that the borrower defaults, that is, fails to meet the obligation to meet full and timely payments of principal and interest according to the terms of the debt security. The second is the loss severity, also known as the loss given default. In the event of default, that is the portion of the bond's value an investor loses. A default can lead to losses of various magnitudes. In most instances, in the event of default, bondholders will recover some value, so there will not be a total loss on the investment. Thus, credit risk is reflected in the distribution of potential losses that may arise from the investor is not paid in full on time. Although it is sometimes important to consider the entire distribution of potential losses and their respective probabilities, it is often convenient to summarize the risk of a single default probability and the loss severity, and to focus on the expected loss. Expected loss equals the default probability times the loss severity given default. The loss severity, and hence the expected loss, can be expressed as either a monetary amount or as a percentage of principal amount. The latter form of expression is generally more useful for analysis because it is independent of the amount of investment. Loss severity is often expressed as a recovery rate, where the recovery rate is the percentage of the principal amount recovered from the event of default. Because default probability is quite low for most quality debt issuers, bond investors tend to focus primarily on assessing the probability and devote less effort to assessing the potential loss severity arising from default. However, as an issuer's default risk arises, investors will focus more on what the recovery rate might be in the event of default. This issue will be discussed in more detail later. Important credit-related risk includes the following: spread risk. Corporate bonds and others credit risky debt instruments typically trade at a yield premium or spread to bonds that have been considered default risk-free, such as U.S. Treasury bonds or German government bonds. Yield spread expressed in basis points widen based on two primary factors: a decline in the issuer's creditworthiness, sometimes called the credit migration or downgrade risk, and the increase in market liquidity risk. These two risks are separate but frequently related. Credit migration risk or downgrade risk is the risk that a bond issuer's creditworthiness deteriorates or migrates lower, leading to investors to believe the risk of default is higher and thus causing the yield spread on the issuer's bond to widen and the price of the bond to fall. The term downgrade refers to the action by the major bond rating agencies, whose role will be covered in more detail in Section 4. Market liquidity risk. This is the risk of the price at which the investor can actually transact. Buying or selling may differ from the price indicated in the market liquidity for them to buy or sell bonds in the quantity they desire. The spread or the yield premium on corporate bonds includes a market liquidity component in addition to the credit risk component. During times of financial stress or crisis, such as in the late 2008, market liquidity can decline sharply, causing yield spreads on corporate bonds and other credit risky debt to widen and the prices to drop. Some research have been done on trying to quantify market liquidity risk, and more is likely to be done in the aftermath of the financial crisis. Capital structure, seniority ranking, and recovery rates. The various debt obligations of a given borrower will not necessarily all have the same seniority ranking, senior, or priority of payment. In this section, we introduce the topic of the issuer's capital structure and discuss the various types of debt claims that may arise from the structure, as well as their ranking and how those rankings can influence recovery rates in the event of a default. Capital structure, the composition and the distribution across operating units of a company's debt and equity, including bank debt, bonds, and all seniority rankings. Preferred stocks and common equities referred to as its capital structure. Some companies and industries have straightforward capital structures with all the debt equity ranked and issued by one main operating entity. Other companies and industries, due to their frequent acquisitions and divestitures, e.g. media companies and conglomerates, or high levels of regulations such as banks and utilities, tend to have more complicated capital structures. That's capital structure. Seniority ranking, just as borrowers can issue debt with many different maturity dates and coupons. They can also have many different rankings in terms of seniority. The ranking refers to the priority of payment, with the most senior or highest ranking debt having the first claim on the cash flow and asset of the issuer. This level of seniority can affect the value of the investor's claim in the event of default and restructuring. Broadly, there is secured debt and unsecured debt. Secured debt means that debt holders have a direct claim, a pledge from the issuer on certain assets and their associated cash flows. Unsecured bondholders have only a general claim of the issuer's asset and cash flows. In the event of default, unsecured debt holders claims rank below, i.e. get paid after the secured secured creditors. Now remember, debt comes before equity, so that people who own fixed income instruments get paid before people who own equity. So so this is what it looks like. First lien loans: senior secured, secured, unsecured, subordinated, senior subordinated, junior subordinated, and then it's equities. Okay. With each category of debt, there are a finer graduation of types of rankings within secured debt. There are first mortgages and first lien debt. So this is just the explanation of Exhibit 1. Okay. Recovery rates: all creditors at the same level of the capital structure are treated as one class. Thus, a senior unstructured bondholder whose debt is due 30 years has a same pro rata claim in bankruptcy as one whose debt matures in 6 months. This provision is referred to as the bond ranking, pari passu, or equal footing. Pari passu in the right payment. Default debt will often continue to be traded by investors and brokers, dealers, based on their assessment, and either in liquidation of the bankrupt company's asset, or in recognition the bonds will have some recovery value. In the case of recognition or restructuring, new debt, equity, cash, or some combination thereof could be issued in exchange for the original default debt. As discussed, recovery rates vary by seniority of ranking in a company's capital structure under the priority of claim treatment in bankruptcy. Over many decades, there have been enough defaults to generate statistically meaningful historical data on recovery rates by seniority ranking. Exhibit 2 provides recovery rates by seniority ranking for North American non-financial companies, for example, as shown in Exhibit 2. Okay, so as you can see, it goes from here to here to here, and the people at the top get paid first, and it trickles down. So by the time we get to junior subordinate, you basically have nothing. So debt gets paid before equity. So when it comes to equity, you basically get nothing in the event of default, at least based on this diagram. Okay. Recovery rates can vary widely by the industry. Recovery rates can also be dependent on when they occur in the credit cycle. Okay. These recovery rates are averages. Now that makes a lot of sense. Priority to claims, not always absolute. The priority to claim in bankruptcy, the idea is that the highest ranking creditors gets paid out first, followed by the next level, and on down, like a waterfall, like a trickle down waterfall. Some may say. It is well established that it is often described as absolute in principle. In the event of bankruptcy or liquidation, creditors with a secured claim have the right to value the specific property before any other claims. If the value of the pledged property is less than the absolute of the claim, then the difference becomes a senior unsecured claim. Unsecured creditors have a right to be unpaid in full, to be paid in full before the holders of equity interest. Senior unsecured credit takes priority over subordinate creditors. A creditor is senior unsecured unless expressed subordinated. In practice, however, creditors with lower seniority and even shareholders may receive some consideration without more senior creditors, without more senior creditors being paid in full. Why might this be the case? In bankruptcy, there are different classes of claimants, and in all classes, there are in pairs get to vote to confirm the plan of recognition. This vote is subject to the absolute priority of claims, either by consent of the various parties or the judge's order. However, absolute priority may not be strictly enforced in the final plan. So yeah, there are irregularities and doesn't have to follow the rule. It's worth noting that in the US, the bias towards recognition, reorganization, and recovery of companies in bankruptcy, whereas in other jurisdictions, such as the UK, the bias towards liquidation of companies in bankruptcy is to maximize the value to the banks and other senior creditors. It is also worth noting that the bankruptcy and bankruptcy laws are very complex and can vary greatly by country. So it is difficult to generalize about how creditors will fare, as shown in earlier charts. There is huge variability in recovery rates for default debt. Every case is different. Rating agencies, credit ratings, and their roles in the debt markets. The credit rating agencies, Moody's Securities Services, S&P's, the Fitch rating play a central role and somewhat controversial role in the credit market. For the vast majority of outstanding bonds, at least two of the agencies provide ratings, a symbol-based measure of the potential risk of default of the particular bond or issuer of the debt. In the public and quasi-public bond market, issuers won't offer and investors won't buy bonds that do not carry ratings from Moody's, S&P, or Fitch. It's practice applied for all types of bonds, government or sovereign, government-related, supranational, corporate, non-sovereign government, mortgage, or asset-backed debt. How did the rating agency attain such a dominant position in credit markets? What are the credit ratings and what do they mean? How does the credit that's where we're going. The history of the major rating agencies goes back more than 100 years. John Moody began publishing credit analysis and opinions on the U.S. railroad in 1909. S&P published its first in 1916, and they have grown in size and prominence since then. Many bond investors like the fact that there are independent analysts who meet with the issuers and often have access to material non-public information such as financial projections and investors cannot receive to aid in the analysis. What has also proven very attractive to investors is the credit rating provides direct and easy comparability of relative credit riskiness of all bond issuers within the access industries and bond types. Although there is some debate about rating comparability across the types of bonds, several factors have led to the near universal use of credit ratings in the bond market and in the dominant role of the major credit rating agencies. These factors include the following: independent assessments of credit risk, ease of comparison across bond issuers and market segments, regulatory and statutory reliance on usage, issuer payment for rating, hedge growth of debt markets, development and expansion of bond portfolio management, and accompany bond indexes. However, in the aftermath of the financial crisis of 2008-9, when rating agencies were blamed for contributing to the crisis with their overlying optimistic ratings on security backed by subprime mortgages, there were attempts to reduce the role of dominant positions of the major credit rating agencies. New rules, regulations, and legislations were passed to require agencies to be more transparent, reduce conflicts of interest, and stimulate more competition, challenging the dominance of Moody's, S&P, and Fitch. Additional credit rating agencies have emerged. Some credit rating agencies were well established in their home markets and have since been well known globally. Dominion Bond Rating Services (DBRS) in Canada and Mitsubishi & Co. in Japan have tried to raise their profiles. The market dominance of biggest credit rating agencies, however, remains largely intact. Credit rating and three major global credit rating agencies, Moody's, S&P, and Fitch, use similar symbol-based ratings are basically assessment of the bond's issuer's risk of default. Exhibit 4 shows the long-term rating ranked from highest to lowest. So highest to lowest. The worst you could get is a D, which is a default. D for default. Okay, so this is just interpretation of it. Issuer versus issuer rating. Rating agencies will typically provide both issuer and issue rating, particularly as they relate to corporate debt. Terminologies used to distinguish between issuer and issuer rating includes the corporate family ratings, the corporate credit ratings, or issuer credit ratings, and the credit issuer ratings. An issuer credit rating is meant to address the obligator's overall credit worthiness, its ability and willingness to make timely payments of interest and principal on the debt. The issuer credit rating usually applies to the senior unsecured debt. Issuer rating prefers to specify specific debt obligations if the issuer takes into consideration such factors as rankings in the capital structure, although cross-default provisions, whereby events of default such as non-payment of interest, one bond trigger defaults, and and all outstanding debt implies the same default probability of all issuers. Specific issues may be assigned different credit ratings, higher or lower due to rating adjustment methodologies known as notching. Notching for credit rating agencies, likelihood of default risk, and the primary factors in assessing their rating. However, there is a secondary factor as well. These factors include the priority of payments in the event of default, as well as potential loss of severity in the event of default. Another factor considered by rating agencies is structural subordination, which can arise when the corporations holding the company structure has debt at both the parent holding company and the operating subsidiaries. Debts are operating subsidiaries will get serviced by the cash flow and asset of the subsidiaries before funds have been passed or upstreamed to the holding companies to be serviced at the debt at a later time. Recognition of different payment priorities, and thus the potential of higher or lower loss severity in the event of default. The rating agencies have adopted a notching process whereby the credit ratings on issues can be moved up or down from the issuer rating, which is usually the rating applied to the senior secured debt. At a general level, the higher the senior unsecured rating, the smaller the notching adjustable will be. The reason behind this is that the higher the rating, the lower the perceived risk of default, and so the need to notch of the rating will be comparatively less than if it was higher. For lower rated credits, however, the risk of default is greater, and thus the potential differences in loss for a lower or higher probability of ranking is a bigger consideration in assessing issuers' credit readiness. Thus, the rating agencies will typically apply larger rating adjustments. For example, S&P applies a following notching guidelines. So here's the notching guidelines. Okay. Risk in relying on the agency ratings. The dominant positions of rating agencies in the global market and the global debt market and the near universal use of their credit rating on debt securities suggests that investors believe they do a good job assessing credit risk. In fact, with a few exceptions, their ratings have been proved quite accurate at relative measures of debt of default risk. For example, example 6 shows the historical S&P 1-year global corporate default rates by rating categories of 1991 to 2012 or 2010. Okay. Credit ratings can change over time. Credit ratings tend to lag the market pricing and credit risk. That makes sense. Rating agencies may make mistakes. Some risks are difficult to capture in credit rating. As described, there are risks in relying on credit rating agencies rating when investing in bonds. Thus, while the credit rating agencies will almost certainly continue to play a significant role in the bond market, it is important for investors to perform their own credit analysis and draw their own conclusions regarding the credit risk for a given debt issue or issuer. Traditional credit analysis, corporate debt securities. The goal of credit analysis. Hold up, let me drink my drink real fast. All right. Traditional credit analysis, corporate debt securities. The goal of credit analysis is to assess an issuer's ability to satisfy its debt obligations, including bonds and other indebtedness, such as bank loans. These debt obligations are contracts, the terms of which specify the interest rate to be paid, and the frequency and timing of payments, the maturity date, and the covenants that describe the permissible and required action of the borrower. Because corporate bonds and contracts are enforceable by law, credit analysts generally assume an issuer's willingness to pay and consecrate instead of assessing its ability to pay. Thus, the main focus in credit analysis is to understand the company's ability to generate cash flow over the term of the debt obligations. In doing so, analysts might assess both the credit quality of the company and the fundamentals of the industry in which the company operates. Traditional credit analysis considers the sources, predictability, and sustainability of cash generated by companies to service their debt obligations. This section will focus on the corporate credit analysis. In particular, it will emphasize non-financial companies, financial institutions, have very different business models and funding profiles than industrial and utility companies. Credit analysis versus equity analysis, similarities and differences. The above description of credit analysis suggests credit and equity analysis should be very similar. In many ways, they are in the motivational differences. However, there between equity and fixed income investors that are an important aspect of credit analysis. Strictly speaking, management works for shareholders of a company. Its primary objective is to maximize the value of the company for its owners. In contrast, management's legal duty to its creditors, including bondholders, is to meet the term of the governing contracts. Growth in the value of the corporation from rising profits and cash flows occurs to the shareholders the best outcome for bondholders is to receive a full-time repayments of interest and repayments of principals when due. Conversely, shareholders are more exposed to the decline of value of a company's earnings and cash flow declined because bondholders have a prior claim to the cash flow as assets, right? So that is similar to equity. That's what it's talking about. But the company's earnings and the cash flows to the extent that it can no longer make the debt repayments, the bondholders are at risk of loss as well. In summary, in exchanges for prior claims on cash flows and assets, bondholders do not share the growth and value of a company, but have downside risk in the event of default. So this is the difference between assessing an equity piece and assessing a debt piece. So an equity piece is more concerned about the upside, while a debt piece is more concerned about a downside. The 4 C's of credit analysis, a useful framework: the capacity, the collateral, the covenants, and the character. Capacity, collateral, covenants, and character. The capacity refers to ability for the borrower. Capacity is the ability for the borrower. Capacity refers to ability for the borrower to make the debt payments on time. And this is the focus of this section. Collateral refers to the quality and value of the assets supporting the issuer's indebtedness. Covenants is the term of the conditions of the lending agreements that the issuer may comply with. Character refers to the quality of management. Each of those will now be covered in greater detail. So that's what they are. Okay. Collateral. Credit risk versus return yields and spreads. The material in this section applies to all bonds subject to credit risk. For simplicity, in what follows, all such bonds are sometimes referred to as corporate bonds. As in other types of investing, taking more risk, credit offers higher potential returns, but with more volatility and less certainty. Earnings that return. Using credit rating as a proxy for risk, Exhibit 13 shows the composite yield to maturity for bonds of all maturities with each rating category of U.S. and European bond markets, according to the Barclays, one of the largest providers of fixed income market indexes. Drink. Okay, Exhibit 13. Note that the lower the credit quality, the higher the quoted yield. The realized yield or return will almost always be different because of changes in the interest rate and credit rating risk discussed earlier. For example, the aggregate credit loss will eat up some of the yield premiums offered by the lower quality bond versus higher quality credits. Trailing 12-month returns by credit rating categories and the volatility or the standard deviation of those returns as shown in Exhibit 14. As shown in this exhibit, the higher the credit risk, the greater the return potential, and the higher the volatility of that return. The pattern is consistent with other types of investing that involves risk and return. For extremely liquid bonds that are deemed to be virtually non-default risk, is a function of real interest rates plus the extended inflation rate of the maturity premium. Of course, these factors These factors are present in corporate bonds as well. In addition, the yield on corporate bonds will include a liquidity premium and a credit spread intended to compensate investors for those additional risks as well as for the expected level of credit loss. Thus, the yield on a corporate bond can be decomposed as such. Okay. The market's willingness to bear risk will affect each of those components in general. However, it is not possible to directly observe the market's assessment of a component separately. Analysts can only observe total yield spread. Spread on all corporate bonds can be affected by a number of factors. The lower quality issuer are typically experiencing greater spread volatility. These factors, which are frequently linked to include the following: credit cycle, broader economic conditions, financial market performance overall, including entities, equities, broker-dealers' willingness to provide sufficient capital for market making, general market supply and demand. Each of these four factors play a role during the financial crisis of 2008 and 9. I think they mentioned the financial crisis of 8 to 9 a lot right here, but they failed to mention any of it when it talked about asset-backed securities. And I have to give it to the CFA Institute. This is kind of weird that in a chapter, I believe is what, 50, it's a 50, 53? Is it 53? They talk about asset-backed securities, but they failed to mention the financial crisis of 2008 to 2009. And I was like, dude, you guys should mention that, at least, acknowledge that subprime mortgages are a big part to why Lehman Brothers fell, to why many of these companies actually fell in 2008. So, I mean, it's kind of weird that they didn't mention that, but sure. We have discussed how yield spreads on credit risky debt obligations, such as corporate bonds, can fluctuate based on a number of factors, including changes in the market views of issuer-specific on idiosyncratic risk. The next question to ask is how these spreads changes affects the price of and the return on the bonds. Although bond investors do concern themselves with default risk, recall that the probability of default for higher quality bonds are typically very low. For example, if the government bond, for example, the U.S. 10-year Treasury bond defaults, your biggest issue shouldn't be that you lost your investment. Your biggest problem should be, what the heck? Why is the government bond defaulting? And if the government bond is defaulting, you probably have bigger problems to face than, your little investment. Although bond investors do concern themselves with default risk, recall the probability of default for higher quality bonds is typically very low. For investment-grade bonds, annual defaults are always well below 1%. On the other hand, default risks can be very high for low-quality issuers, although they're very widely depending upon the credit cycle. Among other things, what most investors in investment-grade debt focus on is the debt default risk is spread risk. That of the simplest example is that of a small instantaneous change in the yield spread. In that case, the price impact, i.e. the percentage changes in price, can be approximated by price impact is roughly equal to minus the MDIR, the duration, and the delta spread. Okay. AT&T U.S. Treasury. So you see the yield is greater than U.S. Treasury because the perceived risk of default is higher for AT&T. Now that makes a lot of sense because U.S. Treasury has never defaulted. The government always pays back its debt, and it's basically so you see, if you leave your money in a savings, if a corporation, let's say Apple, leaves their money in a treasury account, it is only backed by the FDIC up to $250,000, right? However, if they put all your assets into cash and cash on cash equivalents as their balance sheet will state, cash and cash equivalents such as U.S. Treasuries, they're backed up to 100% by the U.S. Treasury, by the FDIC, by the U.S. government. So that's why corporations actually put their assets and the highly liquid assets, such as U.S. Treasuries and Treasury bonds, and cash on cash equivalents such as bonds, because they are much safer than just putting it in cash. For example, Apple puts all their cash in Bank of America Merrill Lynch, and it's only back up to a quarter million. Apple has billions of dollars, hundreds of billions of dollars in cash. Now, why would you put it in cash? Put it in U.S. Treasury. That's backed by the U.S. government up to 100%. Because it's the Treasury bonds. They never default on the Treasury bonds. In summary, the spread change has a significant impact on the performance of credit risky bonds over a given holding period, and the higher the modified duration of the bonds, the greater the price impact of the change in the spread. Wider spreads hurts bond performance, whereas narrower spreads help bond performance. For bond investors who actively manage their portfolios, forecasting spread changes and expected credit losses on both individual bonds and their broader portfolios, and the important strategy for enhancing investment performance. Special considerations for high yield sovereign and non-sovereign credit analysis. Thus far, we have focused primarily on basic principles of credit analysis and investing, with emphasis on higher quality investment grade corporate bonds. Although many of these principles may be applicable to credit risky segments of the bond market, there are still some differences in the credit analysis that need to be considered. This section focuses on special considerations in evaluating the credit of debt issuers from the following three market segments: high yield corporate bonds, sovereign bonds, and non-sovereign government bonds. High yield, okay. We call the high yield non-investment grade corporate bonds are those rated below Baa3 or BBB minus. By the major rating agencies, these bonds are sometimes referred to as junk bonds because of the high risk inherent in the weak balance sheets and or poor loss proven driven prospects. There are many reasons companies are rated below investment grades, including higher leverage capital structure, weak or limited operating history, limited or negative free cash flows, highly cyclical businesses, poor management, risky financial policies, lack of scale and or competitive advantages, large off-balance sheet liabilities, declining industries, companies with weak balance sheets and or business profiles, have lower margins for errors and greater risk for default relative to high quality investment grade names. And a higher risk of default means more attention must be paid to recovery analysis. Consequently, high yield analysis typically is more in depth than investment grade analysis and does have special consideration. Thus includes the following: greater focus on issuer liquidity and focus and cash flow, detailed financial projections, entailed understanding and analysis of debt structures, understanding of an issuer's corporate structure, covenants, equity-like approach to high yield analysis. Liquidity is that is having cash and or the ability to generate or raise cash is important in all issues. Is absolutely critical for high yield companies. Investment grade companies typically have substantial cash on their balance sheet to generate a lot of cash from the operations relative to their debt, and or are presumed to have alternate sources of liquidity such as bank lines and commercial papers. For these reasons, investment grade companies can more easily roll over or refinance maturing debt. On the other hand, high yield companies may not have these options available. For example, there is no high yield commercial paper market. The bank credit facilitates often carry tighter restrictions for high yield companies. Both bad company-specific news and difficult financial market conditions can lead to high-yield companies being unable to access the debt markets, and although the vast majority of investment-grade corporate debt issuers have publicly traded equities and can thus use the equity as a financing option, many high-yield companies are privately held and thus don't have access to public equity markets. Thus, issuers' liquidity is a key focus in high-yield analysis. Sources of liquidity from strongest to weakest are as follows: cash on the balance sheet, working capital, operating cash flows, bank credit facilities, equity, insurance, asset sales. Cash on the balance sheet is easy to see and self-evident as a source of repaying debt. As mentioned earlier in this reading, working capital can be a large source of use of liquidity, depending on the source amount. It is the use of the company's cash conversion cycles and the role of the company's operations. Operating cash flows is a ready source of liquidity as sales turn to receivables, which turns into cash over a fairly short time period. Bank lines or credit facilities can be an important source of liquidity, though there may be some covenant relating to the use of bank lines, which are crucial to know and will be covered a little later. Equity issuance may not be a reliable source of liquidity because an issuer is private or because of poor market conditions. If a company does not have a publicly traded equity, asset sales are the largest reliable source of liquidity, both because the potential value of the actual time of closing can be highly uncertain. The amount of these liquid sources should be compared with the amount of timing of upcoming debt maturities. A long amount of debt coming due in the next 6 to 12 months alongside low sources of liquidity will be warning flags for bond investors. and can push the issuers into default because investors may choose not to buy new bonds intended to pay off the existing debt. Insufficient liquidity that is running out of cash and no longer having access to external financing or refinancing or to pay off existing debt is the principal reason for issuers default, although liquidity is important in industry. Although liquidity is important for industrial companies and is absolutely and the absolute necessity for financial firms, as seen as the case of Lehman Brothers and other troubled firms during the financial crisis of 2008. Ooh, Lehman Brothers, spicy. Financial institutions are highly leveraged and often depend on funding longer-term assets with short-term liabilities. Financial projections, because high-yield companies have less room for errors. It's important to forecast or project future earnings and cash flows out several years, perhaps including several scenarios to assess whether the issuer's credit profile is stable, improving, or declining, and thus whether it needs other sources of liquidity as a default risk. Debt structure. A high-yield issuer will often have at least some of the following types of obligations in its debt structure: bank debt, loan lien debt, senior secured debt, subordinated debt, which may include a convertible bonds, preferred stocks. The lower the ranking, the debt structure, the lower the credit rating, and the lower the expected recovery. In the event of default, in exchange for this associated higher risk, investors will normally demand higher yields, as discussed in Section 5 of standard leverage calculation used by creditor analysis. And the beta is the credit quoted at a multiplied of 5.2x leverage for an issuer with several layers of debt. With different expected recovery rates. Higher yield analysts should calculate leverage at each level of the debt structure. Example 10 shows the calculations of gross leverage as measured by debt divided by EBITDA, earnings before tax, deductions and amortization, depreciation and amortization at each level of the debt structure, and net leverage of entire debt structure. Gross leverage calculations do not adjust debt for cash on hand. Net leverage adjusts debt by subtracting cash from total debt. Corporate structures. Many debt issuer corporations, including high-yield companies, utilize a holding company structure with a parent and a separate operating subsidiary known where the issuer's debt resides, and how the cash can move from subsidiary to parent and vice versa are critical to the analysis of high-yield issuers. So, setting up a subsidiary that is in charge of the debt, so in the event of default, the credit reputation does not transfer directly, or at least is through a shell. Okay, so it's not direct. Covenant analysis, as discussed earlier, an analyst of covenants is very important for all bonds. It is especially important for high yield credit because their reduced margins of safety. Key covenants for high yield issuers may include the following: change in control puts, restricted payments, limitations on lien and additional indebtedness, restrictions versus unrestricted subsidiaries. Under the change of control put in the event of acquisitions, bondholders have the right to require the issuer to buy back their debt, often at a par or at some small premium to par value. This covenant is intended to protect creditors from being exposed to a weaker, more indebted borrower as a result of acquisition. For investment-grade issuers, this covenant typically has a two-pronged test: acquisition of borrowers and the consequent downgrade to high-yield ratings. The restricted payment covenant is meant to protect creditors by limiting how much cash can be paid out to shareholders every time. Over time, the restricted payment basket is typically sized relative to the issuer's cash flow and debt outstanding, or being raised, and is the amount that can grow with retained earnings or cash flow, giving management more flexibility to make payouts. The limitations on liens covenants is meant by the limitations on how much secured debt an issuer can have. This covenant is important to unsecured creditors who are structurally subordinate to secured creditors. The higher the amount of debt that is layered ahead of them, the less they stand to recover in the event of default. With regard to restricted versus unrestricted subsidiaries, issuers may classify certain of their subsidiaries as restricted and others as unrestricted as it pertains to offering guarantees for their holdings company's debt. The subsidiary guarantees can be very useful to holding companies' creditors because they put their debt on equal standing or pari passu with debt and subsidiaries instead of with structurally subordinated debt. Okay. Sovereign debt, this includes government and municipal debt, and they are perceived to be the lowest risk of non-sovereign debt. This includes like city debt, city statewide debt. Okay, summary. Let's get into the summary. Okay, wow, we're actually reaching the end. I started reading a CFA Level 1 program curriculum May of 2020, and now it's February, it's mid-February of 2021, so almost a year. I've been reading this, and I'm glad I'm almost getting to the end. So just push on. There's nothing to forget the things behind. Push onwards to the death before. In this reading, we have introduced readers to basic principles of credit analysis. We described the importance of the credit market and the credit-related risk. We discussed the role of importance of credit rating and the methodology associated with aligning ratings, as well as risk of relying on credit ratings. The rating covered the key components of credit analysis and a financial measure used to help access creditworthiness. We also discussed risk versus return when investing in credit and how spreads change affect holding periods returns. In addition, we addressed the special considerations to take into account when doing credit analysis of high-yield companies, sovereign borrowers, and non-sovereign government bonds. Credit risk is a risk of loss resulting from the borrowers failing to make full and timely payments of interest and or principal. The key components of credit risk and risk of default and the loss severity in the event of default. The product of two is expected loss. Investors in higher quality bond tend not to focus on loss severity because default risk for those securities is low. Loss severity equals 1 minus a recovery rate. Credit-related risk includes downgrade risk and market liquidity risk. Either of those can cause a yield premium to rise, bond prices to fall. Downgrade risk refers to the decline in the issuer's creditworthiness. Downgrades will cause its bonds to trade with wider yield spreads, then thus lower prices. Wider yield spreads refers to yield to the risk-free rate of return. Okay. Market liquidity refers to the widening of the bid and ask spread of the issuer's bonds. Lower quality bonds tend to have greater market liquidity risk than higher quality bonds, and during times of market or financial stress, market liquidity risk rises. The composition of an issuer's debt and equity is referred to as its capital structure. Debt ranks ahead of all types of equity with respect to priority of payment, and within the debt component of the capital structure, there can be varying levels of seniority of respect to priority of claims. Secured debt ranks ahead of unsecured debt, and within unsecured debt, senior. I keep saying senior because I learned Spanish, and now every time I see senior, I think it's senior. Senior debt ranks ahead of subordinate debt. In the typical case, all an investor's bond and the same probability of default due to cross-default provisional. In most indentures, higher priority of claim implies higher recovery rates, lower loss severity, and the event of default. For issuers with more complex corporate structures, for example, a parent holding company that has operating subsidiaries, debt at holding companies is structurally subordinate to the to subsidiaries' debt. Although the possibility of a more diverse asset, the earnings streams from the source could still result in the parents having higher effective credit quality than a particular subsidiary. Recovery rates can vary greatly by issuer and industry. They are influenced by the composition of the issuer's capital structure, where in the economic and credit cycle the default occurred, and what the market view of the future prospects are for the issuer and the industry. The priority of claim in bankruptcy is not always absolute. It can be influenced by several factors, including the leeway according to the bankruptcy judge, government involvement, or a desire on the part of more senior creditors to settle with the more junior creditors and allow the issuers to emerge from bankruptcy. And as a going concern, rather than risking a smaller and delayed recovery in the event of liquidation of the borrower. Credit rating agencies such as Moody's, Standard & Poor's, and Fitch plays a central role in the credit market. Nearly every bond issued in the bond debt market carries a credit rating, which are opinions about a bond's issuer's credit worthiness. Credit rating enables investors to compare the credit risk of debt issuers and issuers within a given industry, across industries, and across geographic markets. Bonds rated AA or AA, big A, small a, or big B, small a 3 by Moody's and AAA, all cap, and BBB minus, all cap, by Standard & Poor's, S&P, and Fitch, or lower, are reflected as investment grade bonds. So the rating agencies and the rating, we have a table at top, so quite useful if you know the table, at least know the basics and the cutoff regions. The rating agencies, both issuers and issuees. Our issuer ratings are meant to address the issuer's overall credit worthiness. The risk of default ratings for issuees incorporate such factors as their rankings and the capital structure. The rating agencies will notch issuer ratings up or down to account for factors as capital structure ratings for secured or subordinate bonds reflecting different recovery rates. In the event of default, ratings may be notched due to structural subordination. There are risks in relying too much on credit rating agencies. Our credit worthiness may change over time. The initial or current rating does not necessarily reflect the credit worthiness of an issuer or bond over the investor's holding period. Valuations often adjust both before rating changes, and the notching process may not adequately reflect the price decline of a bond that is lower ranked in the capital structure, because rating primarily reflects the probability of default but not necessarily the severity of loss given default. Given default, bonds with the same rating may have significantly different expected losses. Like analysis, credit rating agencies may have difficulty forecasting certain credit negative outcomes, such as adverse litigation, leverage corporate transactions, and such low probability / high severity events as earthquakes and hurricanes. Okay, the role of corporate credit analysis is to assess the company's ability to make timely payments of interest and to repay principal at maturity. Credit analysis is similar to equity analysis and is most important to understand, however, that bonds and contracts that management duty to bondholders and other creditors is limited to the term of the contract. In contrast, management's duty to shareholders is to act in the best interest of trying to maximize the value of the company, perhaps even at the expense of bondholders at times. Let me drink my drink. Credit analysts tend to focus more on the downside risk given asymmetry of the risk return, whereas equity and analysts focus more on upside opportunity from earnings growth and so on. The 4 C's of credit are capacity, collateral, covenants, and character. Provides a useful framework for evaluating credit risk. Credit analysis focuses on issuers' ability to generate cash flow. The analysis states with the industry assessment, structure, and fundamentals. And continues with an analysis of the issuer's competitive positions, management strategies, and track record. Credit measures the use measures and used to calculate an issuer's creditworthiness, as well as to compare its credit quality with peer companies. Key character ratios focus on leverage and investor covenants and use of such measures as beta, earnings before tax, depreciation and amortizations, free cash flows, funds and operations, interest expenses, and balance sheet debt. An issuer's ability to access liquidity is also an important consideration in credit analysis. The higher the credit risk, the greater the offered required yield and potential return demanded by investors. Over time, bonds with more credit risk offers higher returns with the greater volatility of return than bonds with lower credit risk. The yield on credit risk bond comprises the yield on a default risk-free bond with a comparable maturity plus a yield premium or spread that comprises a credit spread on liquidity premium. That spread is intended to compensate investors for credit risk. Yield spread is equal to liquidity premium plus credit spread. In times of financial market stress, liquidity premiums can increase sharply, causing spreads to widen in all credit risky bonds with lower quality issuers most affected in times of credit improvement or stability. However, credit spreads can narrow sharply as well, providing attractive investment returns. Credit curves, the plot of yield spreads for a given bond issuer across the yield curve, are typically upward sloping, with the exception of high premium priced bonds and distressed bonds, where credit curves can be inverted because of the fear of default. When all creditors at a given ranking in the capital structure will receive the same recovery rate without regard to debt maturity, the impact of spread changes and holding period returns for credit risky bonds are a product of two primary factors: the basis point spread change and the sensitivity of price of yield as reflected by modified duration of convexity. Spread narrowing enhances holding period returns, whereas spread widenings have a negative impact on the holding period returns. Longer duration bonds have a greater price and return sensitivity to changes in spreads with short duration bonds. Okay. For high yield bonds with their greater risk of default, more emphasis should be placed on the issuer's source of liquidity as well as its debt structure and corporate structure. Credit risk can vary greatly across the issuer's debt structure depending on the seniority ranking. Seniority ranking in different. I can't say that word, man. Senior. Okay, resulting in different levels of credit. Senior ranking. ¿Qué pasa? ¿Estás bien? Resulting in different levels of credit rating depending on where the debt resides. Covenant analysis is especially important for high yield bonds. Key covenant includes payment restrictions, limitations on liens, change in control, covenant maintenance tests, and any guarantees from restricted subsidiaries. Covenant language can be very technical and logistic, and it may help to seek legal and expert assistance. An equity-like approach to high-yield analysis can be helpful. Calculating and comparing enterprise values with EBITDA and debt over EBITDA can show a level of equity cushion over support beneath an issuer's debt. Sovereign credit analysis includes assessing both an issuer's ability and willingness to pay its debt obligations. Willingness to pay is important because due to sovereign immunity, a sovereign government cannot be forced to pay its debt. Ooh. Argentina be taking notes now, eh? A sovereign government cannot be forced to pay its debt, and Argentina takes as a notepad and prints a lot of money to pay its debt back. Fortunately, that's not how fiscal policy works. In assessing sovereign credit risk, it's a helpful framework. It's a focus on 5 broad areas: the institutional effectiveness of political risk, economic restructuring of the growth prospects. If you're a banker in Tsar Russia in 1917, you will better flee. I mean, modern banking theory or modern monetary theory isn't really a thing back in the 1917 in Tsar Russia, but most of this modern banking nonsense came out of the Great Depression. Thank you, John Maynard Keynes. Okay. Among the characteristics of a high-quality sovereign credit are the absence of corruption and or challenges to political frameworks, governmental checks on balances, respect of the rule of law, property rights, tell that to communist China, commitment to honor debt, high per capita income with stable broad-based growth prospects, controlled of a reserve, or actively traded currencies, currency flexibility, low foreign debt and foreign financing needs relative to receipts in foreign currencies, stable or declining ratios of debt to GDP, low debt service as a percent of revenue, low ratios of net debt up to GDP, operationally independent central banks track records of low and stable inflation and a well-developed banking system, and achieve monkey markets. Non-sovereign or local government bonds, including municipal bonds, and are typically either general obligation bonds or revenue bonds. General obligations or go bonds are backed by the taxing authorities, which in the case is the IRS. The IRS, I never thought about this, but what's the relationship between the IRS, the SEC, and the Federal Reserve? What's their relation? I know they're all branches of the government, but how are they related? Are they under the same jurisdiction? Or are they like the SEC also monitors the IRS, or they work together? I know the FBI works with all of these. This is really interesting. I never actually thought about this. So what's the relationship between the Federal Reserve, the SEC, and the IRS? That's really interesting. Okay. Anyways, debt burden per capita versus income per capita, tax burden, demographics, income diversity, underfunded, the off-balance sheet liabilities such as the pensions for public employees and retirees are debt-like in nature. Revenues back bonds support specific projects such as toll roads, bridges, airports, and other infrastructures. The creditworthiness comes from the revenues generated by the use of fees and tolls levied. Okay, I believe this is the end of this section. I never actually thought about a relationship between the SEC, the IRS, and the Federal Reserve. I know these are all branches of the government that deals with money, that deals with internal revenues, that deals with monetary policies. And okay, and I know the monetary policies are set by the monetary authority, which in the U.S. would be the Federal Reserve, right? But who sets the fiscal policy? I know Congress has to pass on the government spending bill. So is Congress in charge of fiscal policy? And what's the relationship between the SEC, the Congress, the fiscal authority, the monetary authority, the IRS? The IRS isn't even part of the fiscal or monetary authority. It's just their own separate entity. So I'm kind of interested in that. I really don't know the SEC or IRS or Federal Reserve, their equivalents in other countries such as the UK or the Eurozone. Anyway, so yeah, that's the end of this section. We'll be getting into derivatives. And I'm really looking forward to finishing the section of the CFA level 1. And I do hope my readings have been helpful, and the show notes are on Amazon, so you guys just head there. And I hope to see you guys next time. Okay, goodbye.